Welcome back, folks. This is the ICT Mentorship Midweek Review for August 19th, 2020. All right, so we had our old low traded to here, and I'm going to scrub back. Right here, this is the low I said we would look for, a run below that. So trading in below these equal lows. We traded down into it there yesterday and today, and then we had some retracement so far. I've kept the fair value gap, premium, and discount levels. And I think as long as we stay below the premium end of that fair value gap, we still maintain a bearish stance on dollar. If we trade above the fair value gap premium level, if it trades above that, we have buy side liquidity resting above here and a fair value gap to consider. So there's your decision making points based on if the market trades up to this point, then we're looking here. If as long as it stays below here, we're going to look for an opportunity to trade a little bit deeper into that fair value gap below the old low, which is indicated with this gray line. Okay, for the hourly chart, you can see how price traded down, respected the premium end of the fair value gap. Now these are old levels, folks. Then it aggressively moves lower, consolidates towards the end of the fair value gap on the discount end, resistance on that, and then trades lower through the old daily low. Another low run here on the rejection block, then creates an optimal trade entry in here, and runs up into the fair value gap there in the form of a SIBI, sell side imbalance, buy side inefficiency. So again, your line in the sand is your premium level here. Keep that on your chart. If it goes above that, we'll be looking for the levels as I indicated on the daily chart. Otherwise, we're consolidating to going lower. Lots of lows still intact in here, so this might be just a short squeeze. And I'm not trying, again, I'm not trying to pick the low or the bottom of the dollar. A 15-minute time frame, you can see the order block here. Small little fair value gap, which it trades into there. Optimal trade entry. Time of day, New York session. Runs up into the imbalance that's shown on the hourly chart. So it's important to watch where we trade and how we trade inside this old daily fair value gap. It can run a little bit deeper and go to consequent encroachment as long as it stays below the premium end of the fair value gap. Then it should remain bearish. But obviously if we trade above that, then that changes everything and the narrative is no longer bearish. All right, so let's roll on into the euro dollar. So here's euro. And we have fair value gap levels and an old high level. So think about how price was trading here and now we're trading up here. So we had relative equal highs in the form of a high resistance on the lower time frame. So we had our resistance here with the higher high than this one. So it set the stage for a high resistance liquidity run. It doesn't mean it can't run through it. It just means it's going to be a lot of give and take back and forth, and you experience that by monitoring the euro. And I'm going to show you what we're indicating here. This candle's up close, 119.42 and 4. Okay, that is your rejection block there. And you can see, let me zoom in a little bit. We trade through it yesterday and today, and now we're trading lower as a result of that. Now again, I want to see how we trade at the fair value gap discount level, because we have a fair value gap in here, and that fair value gap discount from the daily, again, back in history. Again, these levels have been on our chart, so your notes should also indicate what they are. The notes that you keep in your journal, whenever I have references like this on our higher time frame charts, it's probably a good idea to write down what the anchor points are by date and what it is in reference to the time frame. For instance, if it's daily fair value gap discount level, what date is it that it's anchored to, and vice versa with the fair value gap on the premium level, which date is framing that particular level. And if it's a lower time frame, the date and what time of the day. Makes it a little bit easier to keep reference of things like that. Not essential, but for organizational purposes, it's worthwhile. So we do have sell side liquidity in here, and if we break below the discount level, then we have to contend potentially with these relative equal lows. This one's higher than this one, and we have a fair value gap there. So how much of the ground does it give way? If it really starts to break down in here like that, then we probably made some kind of important high that would lead to maybe a deeper retracement into this fair value gap, if in fact it comes to fruition. I'm not forecasting that, because to do that, I'm basically trying to pick the top in euro and the bottom in dollar, and I'm trying to avoid teaching that because I don't actively pursue it myself in my own trading. Dropping down into an hourly chart, okay, you can see, look at the price action between the old rejection block on the daily chart and the fair value gap premium level. All the candles are staying inside there. We trade up into mean threshold. Last up close candle, split that in half, bang, hits it. Trade back down, find some support around the top end of the fair value gap. Consolidates, again, the bodies stay within it. Breaks down. Fair value gap, relative equal lows, real clean. Trades down into that. Now we have a little bit of an imbalance in here, and it does not need to trade all the way back up to here. So let's play devil's advocate for a moment and say this is going to go lower and attack the sell side liquidity resting below here. This candle here, this down candle, has created a SIBI, sell side imbalance, buy side inefficiency. That's the type of fair value gap this is. All it needs to do is trade back to this candle's high or just above it, and that would be your institutional order flow entry drill. So if you want to practice counter trend, it's not an enticement for you to try to go in here and try to do that, okay? But to practice with it, you would look for any movement above this candle's high, and that high is 119.09 and 3 pipettes. So if it trades at that price level or a little bit higher, all the way up to the low, this last up close candle, that would completely close in and rebalance this SIBI. Work with using this candle's high if it trades there, and maybe exercise that with a short drill. In other words, trying to sell short and then use the high of this candle for your stop. Now that may be a whole lot of pips for your liking, but it's okay, because there's nothing saying that this wouldn't exist in structure on a 5-minute chart, and it would be just a lot less pips. You want to engage and practice with these elements like this. So if we start to trade back up into here, practice and see what it feels like to be in that trade while going against the higher time frame order flow. And you'll see how many times it'll be hard, really, really hard to hold those trades and watch them pan out, because it could potentially pan out in a very quick fashion. Should it trade up here, it could go there and aggressively sell off. Or it can go up there and then dilly-dally around and then go one more time deeper into the fair value gap and go lower and then one more time and completely close it in and start to break down. And you would feel the adversities that comes along with that type of trading. That's the reason why I open up with month one teaching low resistance liquidity runs, because if you have that framework, it's easier to operate inside of price action because you know what you're looking for, and usually the price action is a lot more forgiving. No, it's likely to move in your favor easier, not always, not promised, but then out of trading against the underlying order flow. So dropping into an hourly chart. Okay, so you can see again, look at the price structure. It's just uncanny how it just hangs around in between these key levels. Market comes back, trades into this balanced price range. What makes it a balanced price range? We have one candle here and one candle here. So it works inside of this range. It's going to be very difficult for price to get back above this candle's low. And you can see we had multiple attempts to try. and down she goes. Now it's interesting to see how we had this candle here. This almost gave us an institutional order flow entry drill. If it would have hit that, that would have been an exercise. Even for hindsight, you could look at it and work with it there. We have a small little one here, which also is an old, I think it's an old weekly high if I'm not mistaken. You have to check your notes on that. Don't quote me on that, but we had this level in our charts for a while. So it can trade up into that, rebalance this fair value gap, and then attack these relative equal lows. The low on the right is higher than this one, so it could run to the fair value discount. So even though it's not a lot of pips in here, that's something also you can practice and exercise on. It's not a trade. It's not an invitation to go in here and trade with live funds. That's how you get in there and experience what it's like holding positions without risking any money and gaining the experience of being in the move, not knowing what's going to happen, but testing the theories and see which side of the marketplace it reaches for. Now, I don't like the fact that we've held on to this like this and then broke down. It would need to come back to a deeper discount than just a fair value gap discount level, which is old but not expired. They never really expire, but it would need to go a little bit more deeper than that before I would expect a convincing run to get back above the buy side liquidity in here. All right, so we're going to look at cable now. All right, so here's the British pound. This is our daily chart, and as you can see, our analysis, we were looking for this consolidation, which was crouching right below a liquidity pool and relative equal highs. And remember, we were talking about this level here back in May and how that would be a potential long-term idea. Should price trade up to that point, we would see it reach there. It did that yesterday and today in convincing fashion. This candle here and the red line attached to it, we're looking at the closing price of that candle, which comes in at 131.6. So that's our rejection block. So a rejection block just above these relative equal highs. And again, go back and watch the videos. I counsel you to pay attention to those particular levels. The fact that we were crouching below it, and I said that we would see the first part of this week, the expectation would be to ramp up with large candle and run in here into these levels and clear out some of the buy side liquidity. But to go up there and reject and break down, that I didn't care about. I was only forecasting the initial surge up above that, and that would be the framework for this particular trading week. So first half of this week, when I gave you the review and commentary for last week on our week ending edition, I said that I would be looking for weaker dollar and stronger foreign currency, euro and cable, and both of them traded to their levels respectively. Oh, all three of them really. But now that we've done that, I'm neutral in the week. I don't have a bias. Okay, so this is where we change gears, or at least I change gears because it's fulfilled what I expected. And now the second half of the week, I don't know. And I don't need to know because I've made my pips, I've made my objective and my weekly return already on Monday and Tuesday. So there's no necessity for me to be participating in the market right now. If you choose to engage, do so on a demo account. Try not to go in here with live funds because we are in an area where it could, again, go either way. And we don't want to trade in that environment. Hourly chart. Price runs up. Here's a beautiful optimal trade entry right in here. Fair value gap. Okay. Optimal trade entry. Bullish order block. Fair value gap. Sell side liquidity. Trades down into it here. That is 7 o'clock on the 17th. Price expands. Clears the old relative equal highs. And then closes in on the rejection block. We hit it here, and we hit it here, and we collapse there, creating a fair value gap on the hourly right there. Trades up into institutional order flow entry drill right there. See this candle? That high, all it needs to do is trade into it, and it does here, and aggressively runs into this short-term low, and we have a very small fair value gap in here that may still be a factor for lower prices. Okay, and you can see we traded into it here. So runs up, hits a key level, and then starts to break down. we had the low here broken, and then we trade back up into the fair value gap. 15-minute time frame. Okay, you see a price run here, institutional order flow entry drill. We don't get it there. Price stays bullish, hits the rejection block. One more time, hits it. Failure swing, breaks down right in here. Breaks this low, expands, creates a fair value gap. Almost, if this candle would have been here and did that, that would have been an immediate rebalance. But this is a deferred rebalance because it's one candle later. Retraces back to the low and does it one more time in convincing fashion. Distribution, another SIBI, sell side imbalance, buy side inefficiency, runs up, rebalances that again, and trades aggressively for the relative equal lows here on the 15-minute time frame and fair value gap that's found on the hourly chart. So I don't have a real clear direction as to what it may do for the rest of the week, and as I mentioned already a few minutes ago, try to exercise patience, forge patience. Try not to have this overwhelming desire to participate because price is moving around. There has to be a narrative and a framework to work within. We've hit our targets. The market has traded to our targets. It has reacted in a fashion that we were expecting, but we're not trying to sell short and pick the top in euro and cable, and we're not trying to pick the low or bottom in dollar. So give the market a couple days and try not to participate. You can watch and see and study, but try not to engage. Try to do that. But if you are, I'll give you some things in here to talk about potentially working with exercises and drills on order flow. But don't have too much expectations about that, because if it works in your favor, try not to build too much concern about that being significant, because we're in an environment that you're being trained to sit on your hands now. So it was really nice to see our analysis from last Friday deliver on such a nice precision. It's just, the first half of the week delivered outstandingly. We saw exactly what we were looking for the dollar. We saw exactly what we were looking for the euro, and cable did so in stunning fashion as well. Now, because we have traded like we have, it's important to just sit still. And in fact, it's better for you to now look at this as you've completed, it's basically completed our expectation for this trading week. So in these environments, the times that I would go back in and try to trade again because I wanted to take another win out of the marketplace and feel good, I end up losing money. So this is when I started developing parameters that would stop my trading. Okay, we've seen the targets hit on the three markets that we follow predominantly here. Dollar hit our low end objectives. Euro hit our high end objective. Cable hit its high end objective. Now we were retracing. So we're going into areas that are uncertain, and there's no reason to go back in, because to do so, we're throwing good pips earned into a gamble. So over time, I learned that once I had a expectation of what I think may happen for the next trading week, and if it was devised in such a way that the first half of the week I was comfortable with looking for a specific phenomenon to unfold, if it unfolds, then I stop. And I'm content with missing whatever happens in the marketplace. I don't care, because I'm looking for continuity, consistency, and longevity. And you won't acquire the results you're looking for unless you focus on those three pillars. Okay, so you want consistency, continuity, and longevity. And when you do that, it builds patience. It forges patience, because I don't feel any desire to go in and try to look smart now, because I've delivered. Last Friday, I told you what we were expecting. It's in your charts now. If I go in and try to trade, if I try to do another trade example, even if I was trying to share something on YouTube, it would be breaking my rules. So in true mentorship fashion, and as a mentor, I'm teaching you to practice what I'm living. I try not to do anything now. And if it can move 300 pips between now and Friday's close on any one of these pairs, I don't care. That's not my expectation to capture every single move. I want to find the moves that are easily defined and then go in, engage, do it with as little as possible in terms of risk, and manage the position, if you will, as best as I possibly can. And hopefully, be on the winning side at the end of the transactions. And now we have a long weekend. We don't have to worry about trading on Thursday. We don't have to worry about trading on Friday. And then we have Saturday and Sunday to rest and recoup. And then Monday we will start all over again. So in quick overview, I mentioned that we would look for an all-time high this week on S&P. The cash market has posted a new all-time high on S&P. And I believe that we will have something more to discuss when we get to Friday, because right now there's a gray area where I don't know how to navigate in capacity as a mentor and be able to say, okay, with high probability, it's either this or that. So I have to co-sign every single time I'm sitting down with you, and I'm co-signing now on the sidelines. So because I don't have a directional bias, because I don't have a target for which side of the marketplace is going to reach for, we are in no man's land. So this is a time where I have to sit still, and I've given you reasons why. So that way there's no uncertainty, there's no reason to guess, there's no hidden things being kept from you. It's just real world experience being applied. So hopefully you've again gleaned something, what we've been studying and engaging with for Euro, Cable, and Dollar. I do have an idea that I want to try with the mentorship, and there's going to be a really, really watered down version of it for whenever I post a weekly lesson on my YouTube channel. I got a lot of emails coming in. I have not read them, but some of the titles are really nice. They're saying, look, I'm in your mentorship and I'm getting still lessons from your YouTube stuff that I'm just putting out. And that's good. It's a nice balance. It gives you the greater appreciation for what you're learning here. And you get to sit with me. You're like my co-pilot. So I'm navigating these markets every week with you. And you're getting to see what I'm thinking before it happens, where it should go. So while they can see me do the execution side, they really don't have all the other things that led to the 17th of August being bullish for Euro, because we were looking for these higher time frame levels that aren't being indicated on those examples in YouTube. So there's a big disparity in terms of what they're seeing, and I'm not trying to make light of them, like I'm punishing them. They're actually, if you are honest and look at what I've shown them, that's gold. I mean, I've literally laid gold in their hands, and for the most part, they're offended because I didn't give it to them as a live trading signal. Okay, I'm not all of them, but I'm sure there's a large degree of them. And then obviously there's other people that are trying to repackage my stuff. They're the ones thumbing down because I've made a very clear indication of what they are trying to do and what we can do, or I can do rather, and you're learning to do. So go into this weekend with the expectation of not wanting to participate anymore and relax, and then we'll have more commentary on Friday. Obviously, my PDF files have been abused in the past, and it got shared all over the place. And one of the things I thought about doing was creating kind of like, it's like an interactive study homework type thing. I wanted to create a specific study once a week where I post a chart in a PDF file, okay, and folks can print that out, or they can draw on it with, I guess, whatever online medium they have, and then try to come up with my same view in price action. So it's like, what do you see drills that I used to do on my Twitter before I shut it down. I have people still in the mentorship asking me where my Twitter feed is. Again, I took it down because, and just like I took down my Instagram too, because there was people using the follow list. All of my followers, they were trying to market parts of my mentorship for like $10, and it's just, I got tired of hearing about it, and I took away their prospect lists basically by moving to just YouTube, because no one can see who follows me there. So it's a little bit more private, and it's offensive to me to see these people trying to do that. And that's the only way I can stem it, because people are always going to try to do something like that. It is what it is. But I want to potentially see if I can come up with a way of designing a weekly exercise where I print a chart or provide a raw chart with no annotations, and provide it as a way of saying, okay, mark up on your chart what you see here, and then I'll post mine. And the idea of doing that is not only teaching, and it creates muscle memory. Okay, you'll see things repetitively, and then because you've seen so many examples of things in my responses to, or I don't want to say answers or solutions, because obviously I can look at this fractal right here, and there's lots of things I can talk about. Doesn't mean I'm going to trade every single one of them, but a few of them may be tradable things for you that resonate very, very strongly. But I want to kind of like make it more interactive. And once we finish up in 2021, December 2021, 2022 in January, my time is going to be heavily in the forum. And some of you folks are in like month 3 and 4, and you're like, I want to have access to the mentorships forum. I don't have access to that. Well, you don't have access to that until you're a charter member. But when charter members are given voices, they can ask questions and participate in threads. Right now, I do not have the charter members toggled so they can create new threads, because I have to go through a couple different threads right now, and we're also moving some threads and consolidating some of them. So that's the reason. It just makes it easier for us to manage, because sometimes you folks are just overboard with creating new threads and it's not necessary. I don't know if it's because you just want to have your own thread that you authored or whatever, and that's cool, but at some point, just to post a thread to have one question, maybe 2 responses in it from a member, it's a waste. Okay, so I don't mean to say that your time is a waste or your concern is a waste. It just means once it's been fulfilled and that answer has been provided to you, you don't have a way of deleting your posts. And the reason why that also is like that is because if someone tries to market something outside of our mentorship, you can't hurry up and erase it before I get it, or an admin and moderator goes in and deals with it. So it is ran a little bit like the military here. Okay, other people have called it like a prison in the past, but I have to have some measure of control here, because it just can't be it's not going to be a baby pips. I'll never let it happen. I've let people go, and I've discharged them from the mentorship because of their disrespectful nature in the forum. So anyway, the idea is I'm trying to come up with, and I'm going to spend the rest of this week coming up with a way I can do it where it's a structured approach, it's interactive, and don't disregard the ones I do on the YouTube channel should it transpire, because even though you'll know more than those people that are just simply in the YouTube community, you should do those exercises as well. And the exercises that I show on YouTube will also be amplified in the mentorship. Okay, so with that, now I'm going to go over to the euro again and revisit. All right, so now we're going to talk a little bit about the trade I took on the 17th for illustrative purposes. And let me bring this back up because it's missing. There you go. All right, so I gave a lot of details on the YouTube example. Okay, the things that were missing are what was shared to you all on Friday's weekend edition of the IHT Mentorship Commentary. We were looking for higher prices on euro. We were looking at it in the form of a high resistance liquidity run. And you can see a lot of that give and take in here. But still, even though it's framed under the idea and umbrella, if you will, of a high resistance liquidity run, the signatures still manifest, and they're very strongly linked to time and price. When price went below the relative equal lows here and ran through that, all of this movement here is a Judas swing. When price broke higher and went back down into the previous day's low, which is the 16th, we hit the order block here, and as it's trading lower right into here, this is where you would have been buying down as it's creating this run. When this candle was bold and down close in nature, that's where you'd be buying. Buying it over here in close proximity to the order block is still fine, as you saw. I had my stop loss well below this low here. It was a 15 pip stop loss, and you can also see the leverage I was using was minuscule, because it's not necessary to have a high level of leverage and over risking. The idea that the market would create this buying opportunity is linked to the bullishness that we outlined on last weekend's weekly commentary. The relative equal highs, that was not your final terminus. We were looking for the market to reach up into those 119s, okay, and trade above its old highs that it formed on the daily chart. Inside this breaker, a breaker is an order block. 50% of that order block is the mean threshold. If you take that and extend it out in time, that's what the bodies are respecting here. So there's an overlap of the bullish candle here that caps this run down. It clears the sell side liquidity pool here. Mean threshold, extending it out in time, that's what these bodies are respecting. So the bullish breaker here, when it trades above it, comes back down in, and we have optimal trade entry. We're below 50% of the low to high of this interbank dealing range. So we are in a discount. We trade to optimal trade entry. We trade into the mean threshold of this big down close candle. So we have a mean threshold there. We have the mean threshold of the bullish breaker overlapping with the New York session and with a bullish bias. What was the bias outlined on the weekend edition last Friday? We were looking for higher prices in euro, higher prices on cable, and lower prices on the dollar index. Now, when it left these relative equal highs in here, that is enough. You saw me execute on that, and it's been in the YouTube channel. But on the 18th, yesterday, you can see how price was aggressive in here, but on both sides. We cleared sell side liquidity, then we cleared buy side liquidity, and then we came back down into it deeper here, and then expanded, cleared the highs, came back in. Right in here we have New York session. So we have what? This price swing, then we retrace back down in. All of this price action here, right in here, is keying off of a breaker. What it's trading down into is a breaker. See this low? It's higher than this low. And I'll show you to you like this. Low, lower low. So what's the high in between these two price points? Right here. So this that is your breaker. Okay. Notice the bodies of the candles. That's the mean threshold. Let me zoom in a little bit. So this candle's body is what I'm measuring. That's your high and your low. Split that in half. Extend that out in time. That's what the bodies of these candles are respecting. Yes, we get these little tails, but that's fine. I've already taught you that that is permissible. You have to endure that. because that's where the broker's nasty business comes in. It's not likely you see any of these tails coming all the way down below here. If you do, you have a real problem with your broker, and it's probably time to change. But we have this price run here, and then we trade right back into the mean threshold of this last up close candle, clearing these lows. So the high in the between is this last up close candle, and should we trade above it, which we do, if we come back down into it, that is a bullish breaker. Couple that with okay, you see that 50 level is 19 and 7 pipettes. That's here, and we're trading below it here, so we're at a discount on all this time period inside of a bullish breaker. The bodies of the candles respecting it, so IPTA is absolutely in control of price here. And then finally in New York session yesterday, price expands and blows up through, creating the high in here on this candle at 950. At 950, price retraces, comes all the way down into this buy side imbalance, sell side inefficiency. Then we enter into that consolidation phase between the premium end of the fair value gap and the rejection block on the daily chart for euro, and then we finally collapse. So this price run in here is all breaker based, okay? And that is the last bit of business for this commentary, and we will discuss more on Friday when the week's trading closes. Until I talk to you then, have a pleasant week. Rest. Try to take advantage of Thursday and Friday as just rest days, okay? If you choose not to, good luck, good trading.